Welcome everybody to Volatility Trading Strategies. So first of all, I just want to wish everybody a happy new year. Hopefully this year was a very prosperous one for you, and I wish you the very best of luck going forward in 2017. So I want to discuss in this video something that I feel is a very often overlooked aspect of long-term investing, and that is management fees. Now before I get into that, really quickly, I do want to mention something that I've talked about in several other articles and videos over the years. I mention it quite a bit, and that is that you don't actually have to pay anybody any management fees to get a reasonably good rate of return. So statistically, we know that a well-balanced portfolio of index funds will probably outperform about 75%, possibly more, of the active fund managers out there. So if you are just somebody who's looking to track the markets more or less and get a reasonably good rate of return, you certainly don't need to pay anybody any money for that. But if you are a person who's looking to outperform the markets, and that can be done, by the way, through active management. I'd like to think that I'm one of the managers that can do that. But if you are looking to outperform the markets, it does require some out-of-the-box thinking and some active management, which of course there will be a fee associated with that. So in this video, what I want to do first of all is just illustrate the effects of a percentage-based management fee over an entire investing career. And then after that, I want to show the difference between a percentage-based fee, typically that you'd see in the financial industry, and compare that with a subscription-based fee like I offer. And I think the results might surprise quite a few people, so let's get into that right now. So for those who have been following me over the years, this is going to be very familiar to you, but for anybody who hasn't, this is just a simple retirement fund calculator that I've made in an Excel spreadsheet. You can probably go on Google and download something quite similar to this. But up top here, we've just got all the input variables that we need. And then down below, it's just going to spit out some data, and we can use this to make comparisons. So like I said, what I wanted to do first of all is just really quickly show the effect of a long-term annual fee on a retirement fund. So we're going to be very conservative in these numbers, and we're going to assume a 30-year investment horizon. So maybe you start when you're 40 and you retire when you're 70, which is a fairly typical age to retire. So let's say when you're 40 years old, you start with $25,000. You may not have started with that, but by the time you reach age 40, let's assume you have $25,000. Monthly additions are obviously extremely important. This is going to be one of the largest contributing factors to how much money you have. So let's say $1,000. I think it's a good target for everybody out there. Try to save at least $1,000 a month. Annual rate of return, we're going to use, say, 7%. The reason I'm using 7, I'm going to use that number later on, so let's just keep it consistent. Annual fee, we'll leave that blank for a second. Capital gains, we'll leave this blank as well. We're just going to assume this is all being done in a tax-sheltered account. So if you're an American, maybe an IRA, or Canadians, RRSP, whatever it's called in your country for the tax-sheltered accounts. And then for wage growth and inflation, let's say 2%. And then for wage growth, I usually, just to be conservative, I make that 2% as well. Now in the last 30 years or 40 years, wage growth is definitely positive. But in the last several years, it's actually flattened out. So I want to be conservative and say that there's not going to be any wage growth going forward. Kind of sad, to be honest, but that's for another video. So let's see what we've got. At the end of a 30-year investment career, this person is going to have $1.12 million, which obviously it's a great sum of money. Now, not easy to get. Of course, first of all, you need the 7% rate of return, and you do need to save $1,000 every month. But these are actually quite conservative, realistic numbers for people. Maybe not the annual return if you're talking about financial industry, but there are some active fund managers out there that might be able to get you that 7%. So that's why we're using that number. But let's see what happens if you actually pay somebody a management fee. So you're going to go, let's assume a 2% management fee. Again, very average. Sometimes it's going to be more if you're talking about hedge funds or some financial advisors out there. Sometimes it can be less if you have a high net worth and you're investing in, say, an RIA. It could be less. But let's use 2% and let's see what happens to this $1.12 million. You can see it became $794,000. So again, not the end of the world. That's still a lot of money. But that is significantly lower than you had before. That's about 30% lower. So basically, I'm just trying to illustrate that while it doesn't sound like much, people really oftentimes don't even realize, oh, 2%, that's fine, that's just normal, we pay that to everybody anyway, you can't avoid it. Actually, it's a very significant drain on a long-term fund. Obviously, it depends on the rate of return as well. 2% of 7, that's going to be a significant drain on an account. But you got to remember that a lot of active fund managers out there, maybe 80-85% of them, are not even going to be getting 5%. So this is going to be a very significant hit to a long-term retirement fund. Now, I'm not trying to be a doomsday person and scare anybody. I'm just illustrating that actually management fees is a very, very important aspect of long-term investing. But let's get into the real point of this video, which is to compare this 2% management fee. Well, sorry about that. I hope you guys can't hear that person in the other office next to me. I don't know why people have to yell when they're on the phone. It's like they're talking to somebody who's across the room. They don't realize that the person is literally attached to their ear. But anyway, hopefully that doesn't bother you. But we're trying to compare a 2% management fee with a flat subscription fee. Now I'm going to use mine as the benchmark, my Total Portfolio Solution. I charge $80 per month for that, so that's what we're going to use. All of these numbers up top, we're going to keep those exactly the same. I think it's a pretty good target for people. Try to get yourself $25,000 in an account by the time you're 40. Add that $1,000 per month. It's going to be a huge boost to your long-term returns. And then we're going to use this 7%. The reason that I'm using this, let's just quickly take a look at the S&P 500. Over the last 5 years, it's at 12.6, but obviously this is not a realistic rate of return because it only includes a bull market in the last 5 years. So I've got an S&P 500 calculator here. Over the last 20 years, this is a 5.5% rate of return, annualized rate of return. Of course, it includes bear markets as well, so it's a much more realistic number. If we go back 30 years, we've got 7.5. So that's where this 7% number is coming from. It's basically an estimate of what people more or less can get on their own investing in something like the S&P 500. Not that I'm recommending that, but it's just a number that we're going to use. So I'm just going to duplicate this exact thing, cut and paste it here. And the only difference is we're going to use a monthly subscription fee of $80. So all of these other input variables are going to be the same. 7% rate of return. Of course, flat wage growth. Unfortunately, we've been seeing that in the last few years. So here we are. We're going to compare this person now to the first person who, remember, at the end of 30 years has $794,000. So at the end of 30 years for this person who's paying an $80 a month subscription fee, surprisingly, maybe this surprises people, that's the point of the video, this person is over $1 million, $1.04 million. And more importantly than that, of course, that's a nice boost of over $200,000. But more importantly, if you look in these columns, $517,000 of it is your own money. This is the money, this is the $25,000 plus $1,000 a month added together over 30 years. This is what you put in. You actually investing activity, it's only a boost of 53%. So $276,000, maybe not only, that's a significant amount of money, but 53% of it is from investing activity. For this person playing the flat rate, same $517,000, that's their own money as they've accumulated over time, but this person has made over 100% on their money through investing activity. And that difference, of course, $250,000 difference, that it's basically double. And the reason this is happening is because a flat rate subscription is far more efficient than a management fee. Because as your money grows, of course, that subscription becomes a less and less portion of your long-term fund, right? If you're just starting out, if it's at $50,000 or $100,000, it's probably more or less the same. Early on, it's not quite as noticeable. But over the years, as it's developing, naturally this is going to be a tiny portion of your actual fund. It gets to the point where this $80 subscription fee, if you have enough money, it's going to be a smaller percentage than the actual ETF fees that you're paying on an index fund. It can actually be that efficient. So this is what I wanted to illustrate. Man, that person next to me is just so loud. I'd like to redo this video, but I'm kind of crunched for time here, so I do apologize for that yelling. So that's what I wanted to illustrate. Now, there's a couple of questions that people might be wondering that might spin off from this. The first question is, well, if you have so much more money, only paying $80 per month, how much could you pay to make it equivalent to a 2% fee? That's a good question. And I've actually been asked this question before. So essentially, how much subscription fee do we have to add on to get to this $794? So we're just going to add some numbers here. Let's say $250 you've still got 868. 300, still in the eights. So maybe 350. 767, let's cut it in half and say around 325. That's actually very close, 792. So you could actually pay $325 per month in a subscription fee, and you'd be no worse off than this person paying a 2% annual management fee. Now that's a huge number. My subscription fee is 1/4 of that much. So of course this is a very efficient way to go about investing. Obviously the most efficient way is, like I said in the opening of this video, don't pay anybody any fees at all. But if you do want to beat the market, if you do want to get a 7% rate of return or more than 7% rate, you're going to have to pay a fee. Now, just quickly, I would be remiss if I didn't do a little bit of a plug here for myself. You can see that my annualized rate of return is not 7%. It's significantly higher. Now, of course, in fairness, I just said that we have to include a bear market as well. So the S&P goes down to 7. Let's cut mine in half as well. Let's say 15%. It's still an enormous rate of return considering the fact that you're also paying 1/4 of the fees. So hopefully I've illustrated the fact that people should be looking for those two things, either a higher rate of return or lower fees. If you can get to a situation where you can actually get both of them at the same time, a higher rate of return and lower fees, well, it goes without saying that you'd be doing quite well in retirement. And the other thing people might be wondering is, what kind of numbers can we approach in retirement if we actually get a better rate of return than we can get on our own investing in index funds? You are paying a management fee, so you are expecting to do better than that. So instead of the 7% we were using before, which more or less represents the S&P 500, what if we use something that is in line with what my Total Portfolio Solution has been seeing? Now we're going to go back to this $80 a month and then pull up the results for the Total Portfolio Solution. Now again, I like to be conservative and fair across the board. So because I cut the S&P 500 more or less in half, I'm going to do the same for mine. Instead of 29, let's just say 15. That's half the rate of return, but still 15% over a 30-year time horizon is going to be a tremendous amount of money, as you're going to see shortly, especially when you're only paying $80 a month to get it. So that's $4.7 million. And we can even be more conservative than that. We can go down to 10%. I think people would agree that if they could make a 10% rate of return over the next 30 years, and again, this is a broad portfolio. This isn't a single strategy. My total portfolio is 3 separate strategies meant to be a diversified total portfolio. That's where the name comes from. You would still be looking at 1.8 million, more or less. Now that's a great retirement fund, and it's something that I want to leave people with because I like to be positive. And I like to show people that you don't have to be rich. You can start with $25,000, and you don't have to have a super high paying job either. You can just manage to save $1,000 per month and get a good rate of return, make sure that you're not paying too much in management fees, and everybody out there can retire a millionaire, given that you have 30 years or even, less than that. Just another question might have popped into people's heads. What time horizon would you need? Well, there's the million. We're talking about just under 24 years. So just to be a little bit encouraging as I wrap this video up, anybody out there, it doesn't matter what you do for a living, doesn't matter where you start at, you don't have to be a millionaire, you don't have to inherit money from your family, everybody out there can retire a millionaire. So hopefully I've enlightened people a little bit on the fact that those management fees is actually a pretty huge consideration when planning your long-term retirement goals. Now the flat rate fee, the subscription, is definitely more efficient as I've shown, but I didn't make this video to scare anybody away. If you are one of the ones that's paying a percentage net asset fee, that's fine as long as it's justified. Make sure that you don't gloss over that point because as we've seen, it actually, as you're approaching retirement, is a pretty substantial amount of money. Now the reason that I charge the fees that I do, being so low and so efficient, is because I am a believer that a lot of people out there would actually be better off just trading index funds and saving the fees entirely. So if that's my assumption and that's what I believe in, then the only way I'm going to be able to get people's business is to give them a much better rate of return while still keeping those fees low. That's essentially what I'm doing. And what I often say is twice the returns with half the management fee. Now, of course, I've shown that the returns are actually more than twice as big, and the management fee is about a quarter the size. But, you know, double the returns with half the fees. It does sound a little bit more catchy, so I tend to use that. But that's it. Hopefully everybody has learned a little bit about management fees. It's very important. As always, if you have any comments, go ahead and leave those in the comment section, and I can always address your questions. I can make a video just for you and throw it up here on YouTube. So thanks for watching, and see you next time.